Good afternoon, ladies and gentlemen. I'm Dave Stanley. I'm going to be your host for this webinar. Thank you so much for joining us. I want to tell you a couple of things right at the beginning. Fortunately, you don't have to take any notes. Lana Sanachar is here, who is my good right hand from the Canadian Moneysaver and helps me out with this. And she's going to put all our notes on the Moneysaver website for you. And also, I have a list of references that you can have. Lana tells me we have over 600 people signed up for this, and that's amazing. I really appreciate you making some time for our presentation today. That there's so many of you makes me think maybe our message is getting through to you. It's also a very humbling experience for me. I've had such a large audience to speak to. You see here the disclaimer. I want you to be well aware that I'm not a financial professional. I will do my best for you, but I am an unpaid volunteer for the Moneysaver. So let's go ahead and start. Today we're going to be talking about beating the TSX, and it's a method simply to select stocks of companies in the S&P TSX 60 index. But that's really a very small part of the overall idea of investing. So we're going to start much, much earlier in the process. And for me, saving is the first step. Now, why is it difficult? Everybody says how hard it is to save money. I don't think it's because of a lack of self-control, but it's due to recurring events and pressing needs and things that make us not look into the future. I think it's short-sightedness that prevents us from seeing really what's important. People think that saving is difficult and it requires a heroic tightening of your budget. But you can really make a big difference with automation and by taking advantage of bonuses, tax return, gifts, etc. that you might not have been expecting, simply to put it right into a savings account. The real secret to a financially successful retirement is to save more, work longer, and spend less. I'm sorry to tell you that, but it's the truth. Here's my first graph. You'll see that it's household savings. And really, how discouraging and disappointing is a graph like that. You'll see that back in 1981, 1982, Canadians were saving north of 35% of their disposable income. But sadly, that's eroded. And now, where we are today, people are saving less than 5% of their disposable income, and that's really a recipe for disaster and a recipe for not having a very good retirement. Saving requires foresight and discipline. I will show the other side of that, which is not savings, but debt. How much debt people have. Look at this. Canadians' rising debt load. You look back to 99, how low that was, and you see that by 2013, we're up to 160% of our disposable income in debt. I really suggest that you pay down any debt, especially high-interest credit card debt, before thinking about investing. The goal for you should be to be debt-free by the time you retire. Outstanding debt is a huge obstacle. Well, our second point is, in what should you invest? Well, there are a lot of potential investments, but a mixture of fixed income and equity products produce the best results. In what ratio? That depends on mostly your age, your pension situation, your risk tolerance. Perhaps the most common split is 50-50. But one thing I want to tell you is that you are the only one who can make that decision sensibly. Don't let anybody make it for you. If it doesn't work out, or if you need to make changes, you can alter it down the road. Here's an important point. Taking more risk means a higher percentage of equities, but taking more risk doesn't mean more reward. We're going to talk more about that later. I'm going to talk now about a recent C.D. Howe Institute, the paper that predicting long-term returns of 2.5% nominal and 5% real on long-term bonds, and 6.9% nominal, 4.8% real on stocks. C.D. Howe Institute is here in Canada. They're rather conservative, small c conservative, but I tend to go with their suggestions because I find that over time they tend to be pretty accurate. So what this is saying then, and I suppose you know the difference between nominal and real. Real is corrected for inflation. So 0.5% real on bonds and 4.8% real on stocks. So if you had a value, 50% in stocks, 50% in bonds, you're going to expect a real return of 2.7% for the next decade. And that's a quote from their report. And they conclude that individuals should save more for their retirement to avoid a larger than expected drop in their retirement lifestyles.